On June 12, 2026, the financial world watched SpaceX pull off the largest IPO in history. They raised an unprecedented $75 billion in a single day, instantly giving the company a staggering valuation of $1.77 trillion. The market response was immediate. Shares spiked more than 19% by the closing bell, generating enough instant wealth to mint an estimated 4,400 new millionaires among the company's rank-and-file employees. But look at this chart of their 2025 financials. You can see a massive revenue bar hitting $18.7 billion. Yet right next to it, the net income plunges into a deep red hole. Despite dominating aerospace, the company actually lost $4.9 billion last year. To see where that capital is actually going, we must look past the ticker tape and into the S-1 prospectus, the mandatory regulatory filing that details the mechanics of their entire business model. These documents reveal 3 distinct business segments operating under one name, and only one of them is currently generating a profit. Let's start with the foundational piece of the business, the space segment. Last year, SpaceX rockets lifted over 80% of all global mass to orbit. They have essentially captured the entire launch market. That launch capability built their true cash engine, the Starlink connectivity segment. By deploying their own satellites on their own rockets, they generated $11.4 billion in revenue last year, making this the most highly profitable part of the company. This chart maps out a structural advantage that competitors simply cannot replicate. A SpaceX rocket launches a SpaceX satellite, which then beams subscription data back down to Earth. With over 9,600 operational satellites now in orbit, it's a completely closed, self-sustaining loop. To keep that cycle growing, they need a bigger delivery mechanism. That's why they've poured over $15 billion into developing Starship, a fully reusable next-generation rocket designed to haul much heavier payloads. If the balance sheet stopped here, the financial picture would be clean. A dominant launch provider attached to a high-margin broadband network is a highly profitable machine. But in February 2026, the company absorbed the artificial intelligence startup xAI in a massive merger, pulling the social platform X and its underlying data models directly onto the SpaceX books. This diagram illustrates where the money is going. Starlink's green profits flow directly into xAI's operations, bleeding $2.5 billion every quarter. This spending is necessary to build orbital data centers, massive server racks in space to process AI workloads. The entire investment thesis hinges on this specific gamble. They are taking the cash generated by their near monopoly in space launch and using it to subsidize a deeply unprofitable bet on artificial intelligence. That space dominance also relies on a single massive customer. The federal government has awarded the company roughly $22 billion in cumulative contracts, spanning NASA, the Space Force, and intelligence agencies. Just weeks before the IPO, the Space Force handed them a massive $6.45 billion contract for the Golden Dome Missile Defense Initiative. They secured more funding from that program than every other competing prototype combined. But that deep government integration cuts both ways. The company faces stiff regulatory pushback, like the FCC recently dismissing their spectrum requests, along with the key man governance risk of having a single founder holding 85% of the voting power. With a footprint that spans from missile defense to the lunar landing, the company now functions as a piece of national infrastructure tethered to the shifting tides of geopolitics. When you look at their competitors in the S1, no single rival contests all 3 of their business segments. Instead, different companies are taking targeted shots at individual pieces of the empire. Amazon's Project Kuiper is currently the deepest-pocketed threat to Starlink's broadband business, deploying its own satellite network backed by Amazon's massive balance sheet. For investors who want exposure to the launch market but want to avoid the cash burn of xAI, many are buying shares of Rocket Lab. It functions as a cleaner, smaller-scale proxy for the space economy. This creates a stark divide in how the market values the stock. While retail investors piled in to drive up the initial price, institutional researchers like Morningstar are deeply skeptical, assigning a fair value estimate of just $63 a share, less than half of the IPO price. The market is effectively split in two. One side sees a trillion-dollar empire that will eventually process the world's data from orbit. The other side sees a company trading at 92 times its trailing sales, fully exposed to extreme financial gravity. Ultimately, this public offering forces us to look at what the company actually is today. It is a politically exposed, defense-linked, AI-enabled orbital conglomerate. Operationally, they are positioned to capture the largest macro trends of the next decade perfectly. They own the rockets, the satellite network, and the AI models. But at nearly 100 times sales, the current stock price requires flawless execution. If the Starship timeline slips, or if orbital data centers prove commercially unviable, that extreme valuation leaves absolutely zero margin for error. Investors are no longer guessing whether SpaceX will lead the space economy. They clearly will. The real bet is whether buying that leadership at nearly $2 trillion today leaves any actual room for profit tomorrow.